Zu dem Thema Backtesting ist es uns gelungen, eine der ganz großen Persönlichkeiten der Finanzmarktforschung einzuladen, Professor Campbell Harvey von der Duke University in North Carolina, wo er seit 1986 unterrichtet und forscht. Er ist designierter Präsident der American Finance Association, wird also ab Anfang nächsten Jahres dort den Vorsitz übernehmen. Er genießt allerhöchste internationale Anerkennung für seine Forschungsarbeiten und das auch deshalb, weil seine Forschung immer einen konkreten Anwendungsbezug hat. Er hat mehr als 125 Beiträge zu aktuellen Fragestellungen veröffentlicht in den Top-Journals und dass seine Arbeiten und seine Forschungsergebnisse praxisrelevant sind, zeigt auch die Tatsache, dass er für die Man Group als Investment Strategy Advisor tätig ist und dort immer wieder diesen Brückenschlag zwischen Forschung und Praxis bewerkstelligt. Das soll der Vorrede genug sein. Professor Harvey, we are very excited that you are here and we are looking forward to your presentation about the risks of historical backtests.
It is great to be here. Thank you for that introduction. And I guess we're going to continue along a theme. And the basic theme is data mining. And I'm going to talk about backtests, but it's not the only thing I'm going to talk about. Indeed, I didn't see those two questions before they were posed, and I would have posed them differently. Because question 2 had to do with the real track record, and the real track record could be by luck also. So we need to be careful. So I'll focus on mainly looking at simulated backtests, but I will also talk about real track records, how to interpret them. So let me start by saying that this is actually 4 papers that I'm working on. These are the links to the papers and a picture of my co-author. And I will talk a little bit about each of the papers, and they share a common theme. So let's start with some terminology that I'm going to use throughout the presentation. Type 1 error and type 2 error. This is a type 1 error, where you get a diagnosis that is obviously not a correct diagnosis. Okay? Type 2 error, kind of the same thing, where it's ex post obvious that we've made a mistake. So essentially the type 1 error is you think that there's a finding and it's actually false. A type 2 error is that you missed the finding. Okay, this is going to be very important because there's a trade-off between the two, and it's especially important in asset management. So I'm going to deviate from what's in your book by adding some new material to the presentation. So let me talk a bit about some recent ideas that I've got in terms of the evolutionary foundation of overfitting. Okay, so overfitting is basically you fit something that you think is true, but it isn't. It's just basically by chance it fits the data. So let's go way back in time. The Serengeti, and this is a gazelle. The gazelle hears a rustling sound in the grass, and its reaction is to take off, to use some energy. Because that rustling sound in the grass could have been danger. It turns out that this was a type 1 error, because in this particular case, there was no danger, it was just wind blowing the grass. So the type 2 error, in contrast, is where the gazelle decides not to take off in the rustling in the grass, and obviously the consequence of the type 2 error is pretty substantial. So you kind of see where I'm going here, that the gazelles that actually were very concerned about making a type 1 error So they're willing to make the type 1 error and not willing to make the type 2 error. Type 2 error means death. So is it possible that this is kind of part of an evolutionary foundation where we're more willing to accept a type 1 error? So we think there's a finding, but there's no finding. So is that possible? What about the famous experiment by B.F. Skinner in 1947? So this is kind of experimental psychology. And this is a classic experiment where he puts pigeons in a cage, and the pigeons see no humans, though there's ways to observe them. And every 3 hours, food is dropped for them to eat. Exactly 3 hours. And it does not depend upon their behavior. It's mechanical. So it's not like your dog comes up to you and you can, and it makes a face and then you feed it. No, they're in a cage. Every 3 hours, mechanically, the food is dropped. So Skinner noticed something extraordinary. That before the food was being dropped for one particular pigeon, the pigeon would always do the same thing. It would turn around. Every single time. And then he noticed another pigeon that before the food was dropped, it would do something with his head. 1, 2, 3, before it was dropped. So basically, what's happening here is by random chance, that first pigeon happened to turn around before the first food was dropped and basically made the inference based upon that one experience that there's a relation between turning around and actually getting the food. The same thing with the other pigeon. The pigeon going like this. So again, the paper is fascinating because it's on the origins of superstition. Okay, that something random happens that you actually draw inference. Effectively, this is overfitting. Okay, in the very basic sense. So, what else? Okay, let's go to Klaus Conrad. So this is not a finance person also. He is a person that studies schizophrenia and psychosis. Okay, and he wrote a very famous paper on apophony. And this is the idea that you see a pattern and make incorrect inference. So again, it's very much related to overfitting. We see something in the data and make some inference that's incorrect. So I'll give you some popular examples of seeing something. This is the famous picture of the moon. And people actually thought that this was a sculpture by some ancient civilization, like on the moon. But it's random. And it's possible to see something that is random. And maybe we give the benefit of the doubt because we hadn't been to the moon when this was discovered, and that's a real factor. But other examples, like this one, I'm not sure if you can see it that well, but in the cloud is basically God. Right? So this is just a random occurrence in terms of the cloud. But people will read into this something else. And the most famous example I know, we could probably poll on it, and you're going to guess the most famous example, and yes, I'm going to show it. It is Jesus in the toast. Okay. So, and this is a very serious one because people will have these, it's a miracle, right, for Jesus to appear in the toast for a lot of people. And of course, if I jam enough slices of bread in a toaster, it's going to pixelate something like this or some other familiar sort of face or shape. Okay, so this, again, you're reading something into the data that really isn't there. Okay, so apophony is a type 1 error. So you look at some data and make a false insight. In contrast, epiphany is where you look at often different types of data and you come up with a revelation, and that is a true insight. Okay, so this is important. And again, let's go back to the evolutionary foundations. We've talked about animals, but we really haven't talked about humans that much. There's a book that I highly recommend by Carl Sagan in 1995. It's free on the internet right now. And basically, he was talking about some evolutionary foundations also of the same effect. So his book is called The Demon-Haunted World, and basically what he talks about is the children's ability to do facial recognition and how early that actually occurs and what the implications are. And this is a very cute baby, and basically he's going to argue, given that baby is able to smile at the mother and maybe sometimes the father, that affects the upbringing of that child. So we could contrast this cute baby with another candidate. And Sagan's idea, again, is quite clear. You're less willing to devote the time to a kid that doesn't recognize you. Get a picture of me as a kid also, right there. and this one is the classic, right? Now this is an average effect. It doesn't always work, okay? Example, Ray Dalio, CEO of Bridgewater. I guess he's the exception here. But nevertheless, this is a situation where evolutionary foundation of basically doing a very good job of looking at a little bit of data and basically making an inference. So that's what we're faced with. Now I'm going to switch to finance. And this is a slide from a seminar at Man AHL. So it's a real slide. I give them credit for it. And I've seen many different graphs like this, but maybe not one as good as this. Okay, this is a cumulative profit on a trading strategy. And it's basically 15% return, 50% volatility, Sharpe ratio of 1. It's got 1 year with a very slight negative return right at the beginning, and it's about minus 4%. It does very well during the financial crisis. It doesn't seem to slow down. It's very consistent. This looks exactly like the back test that you would put capital to work on. But is it Jesus in the toast? And it turns out that it is. So what I did here is I generated 200 random series. Not even any real data used. No real data. I just set a random number generator going with exactly a 0 average return and a 15% volatility. So each one of those 200 strategies that were generated are hardwired to have no skill because we're setting the return, the expected return, equal to 0. So what I showed you was the very top, the Sharpe 1 strategy, just picked off the best. I guess I could have showed the Sharpe -1 strategy also, but you can see on average these strategies have a 0 return, but just by chance, one of them is going to look really good. So this is a challenge that we face. It's a basic challenge in investment. When you look at a backtest, how do you know? How do you know it's just not a fluke? How do you know how many things have been tried? And this is just the best one that's picked off. So this is a real challenge to deal with, and I've got actually a way to deal with that. So that's what I want to talk about today. So I will not just kind of criticize what people have done in the past. I've actually got a method to deal with this, a new method. Okay, so it turns out that this idea of having many different tests is not just an issue in finance. It's an issue in many different fields. And I talk in some of my research, I've got a paper that's actually not linked here, and it's about what we can learn in financial economics about the discovery of the Higgs boson. Okay, so Higgs is a great example because the original papers were published in 1964. That's the same year as the famous capital asset pricing model was published by Sharpe. And by 1972, you had a test of Sharpe's model, 1990, Nobel Prizes handed out. But for Higgs, it was a long road because you had to build a giant machine to actually do the testing. And it turns out that it's very difficult to do these tests because there's a lot of things that look like the Higgs signature that are purely by chance. So when they actually do this research, they have a very high hurdle. We're used to a hurdle, the so-called 2 sigma hurdle. So something is significant if it's 2 standard deviations from 0. So it's totally different with particle physics in that the hurdle is 5 sigma. So it's very much more substantial. So particle physics has dealt with the issue of multiple testing, and also another good example is genetic research. So here, basically people are looking for correlations between genes and diseases. So you can imagine if you've got 20,000 genes, there's going to be potentially a relation between some genes and disease just by chance. There's 20,000 things that are tried. I showed you 200. What about 20,000? And it gets even worse because we're talking one gene. What about a sequence of genes? So you start sequencing, then it starts going 20,000 times 19,999 times 19,998. This is a massive number of tests that would be undertaken. And again, some of the findings will be purely by chance. And indeed, the research in genetics, it's not unusual to do 500,000 combinations of genes, which is a fraction of what's available. And again, for them to declare something significant, they use a 5 sigma criteria, just like what happens in particle physics. Okay, so other areas of science have kind of figured this out, but finance has been very slow. Okay, so let's switch to finance, and basically, what I'd like to do is to talk about significance, talk about p-values. Okay, so the idea of the p-value is it's a way to control the type 1 errors. So type 1 error is in my 200 strategies. If I put money on that Sharpe ratio 1 strategy, that would be a type 1 error. Okay, because that strategy going forward has got a 0 expected return. Maybe you might get lucky out of sample and do well for a year or 2, but in the long term, it is a strategy with no skill. It's a type 1 error. And usually what you like to do is to control that error rate to be 5% or less, or so-called 95% confidence. That's what we would like. So we're always looking for the p-value or probability value to be 5% or less. Okay, and then we would something significant. So essentially it means that we've got 95% confidence and we've got a fairly low probability that we're making this type 1 error of allocating to a strategy or an investment that is basically an unskilled or false investment. Okay? So that's the probability. But, and this is a really big but, people in the past have not in financial economics literature allowed for this idea of multiple tests. Okay, so the 2 sigma rule that generates the 5% is only appropriate if there's a single test. So you've got something that you want to explain or forecast, and you pick a variable, you do that test, it's a one-shot test. So think of, you've got some variable y that you're interested in forecasting, you choose an x, you do it, and you're done, and the 2 sigma rule is fine for a 5% kind of p-value or tolerance for a type 1 error. As soon as you start trying different variables, then you've got a big problem. And this table shows that if we try 20 things, then there's a 64% chance that we will get something that is 2 sigma. 64% chance. So essentially, just by fluke, something is going to look significant by the standard way that we think about it. But it's not. So you try 20 things, one will have that 2 sigma, but it's false. Okay, so this is a real challenge because we know what happens in data mining. So in data mining, you're looking at potentially thousands or millions of variables trying to find a pattern. Okay, so what this is saying is that you can be very misled if you use the standard ways that we think about doing statistics. I also highlight 26, and let me explain that one in a minute. First, let me go back to 20. So I note XKCD, jelly beans, and acne. It's kind of a strange notation. I should explain it. If you don't know XKCD, go to the internet and look it up. It is a cartoon, but it's a cartoon for us. Okay, it is a cartoon for people that know a little bit about quantitative stuff. And the cartoon that I'm going to talk about is called significance. So the idea is that somebody says, well, oh, I hear that jelly beans cause acne. And then the next frame is scientists go do an experiment. So they do the experiment. You can imagine what it looks like. You've got a group that takes jelly beans. You've got a control group that doesn't do the jelly beans. It's called a randomized control trial. And then you look at the difference. You count the acne, essentially. So they do it, and it turns out that there's no significant difference. So the p-value is above 5%. And that's the third frame. So, okay, we dispose with this. But then the fourth frame says, oh, well, it's not just the jelly bean, it's the color of the jelly bean. And then there are 20 frames where basically they go do 20 experiments. Same thing, but with different colors. So a group gets red jelly beans, and another group gets no jelly beans. And they find, well, that's not significant. Not significant. So you keep on going down the list until the very last one is the green jelly bean. And the green jelly bean, they find that there's a significant relation. Okay, so in the last frame is the classic. It's the newspaper headline that says, scientists find link between green jelly beans and acne. And that's how a lot of science operates, especially in pharmaceutical. Okay, so again, there's a 64% chance that we're going to find by fluke a relationship in that particular example. Again, let me go back to 26. Why 26? Well, there's a paper floating around in the United States that basically makes the argument that stocks that have a ticker symbol or a company name that begins with the letter A outperform. It's the same thing. It's the same thing. So again, there's a 74% chance that there's going to be a fluke finding, just like that. And this could be ridiculous, right? We could not do the first letter, we could do the second letter. And we will find, and who knows what that letter is? Maybe it's P. Just by random chance, that sort of grouping could outperform in the past history. Going forward, it's destined to fail. Okay, so again, it gets ridiculous once we go to 50 tests, where there's a 92% chance of finding something purely by fluke. Okay, let's get on to factors, and maybe we can call these alt betas if you want, or investment strategies if you want. And these are some examples from the academic literature. This is a recent paper by Nobel laureate Fama and French, proposing a 5-factor model. Indeed, I saw this paper presented early and interrupted Fama in the presentation. And I said to him, well, what about the other 5-factor model? And he said, what do you mean? I said, well, the one you published in 1993 that had 2 additional factors from his famous 3-factor model. And he says, oh, I forgot about that. I don't know how we could forget about it. It's a famous paper. So he said, well, maybe it's 7. Okay, so 3 plus 2 plus 2 is 7. So 5 factors could be 15. This is another recent paper. And again, we're trying to explain why some stocks outperform and other stocks underperform. MSCI, 82. MSCI Barra. Indeed, some of these I'm a little suspicious of, like I highlight the cube of size. So I'm all for nonlinearity, and nonlinear effect, usually it works like this. You put the level in, you put the square in, you put the cube in, and then you keep on going. This is the cube without the square. So I'm suspicious that this, and I don't know what the economic story is behind this factor, so I'm suspicious. So again, when you've got so many factors, some of these are going to look good purely by chance. This is 82, but this is not the worst. This is S&P Capital IQ. And I just lifted some stuff from their website. Actually, it's interesting because their website, in one part of the website, they talk about 400 factors. In another part, they've got 450, and I think they're over 500 now. 500 separate ways that you can outperform the market. Indeed, at some point, you get the number of factors equaling the number of securities out there, you've got a real problem. Just by construction, you're going to outperform. So again, outperform historically, going forward is a different story. Indeed, it says here, access to 450 quantitative stock selection signals spanning seminal academic literature. Actually, it kind of implies there's 450 seminal papers in finance, and no, I don't think so. Maybe there's 5 of them. And the one that I'm thinking of would be the capital asset pricing model for factor number 1. Okay, so I think that this is not where we want to go, and people that invest in these types of factors are going to be disappointed. Okay, so basically what am I going to do? What I do in one of my papers is to provide a way to re-look at the history of discovery in finance and make adjustments for these multiple tests that have gone on, to allow for the fact that some of these will show up as significant just by random chance. But I couldn't just go to the statistics literature and lift a technique, because there's a few things that are very important in what we do in finance that are different than what's been studied in statistics. Number 1 is the correlation amongst tests. So it is a lot different if I look at 100 different momentum strategies than 100 independent types of strategies. Okay, the momentum strategies are all going to be correlated. Indeed, and just as a thought experiment, if they're perfectly correlated, it's just one test. Okay, so my technique allows for the researcher to input the level of correlation of the strategies and make an adjustment based upon that level of correlation. The other thing I mentioned here is the so-called publication bias. And what that means is many papers have been published showing that a factor supposedly works, but we don't observe all of the research that didn't work. It never made it to publication. And that could be hundreds, it could be thousands of ideas. Okay, and the way to count is the total number of tests. The total number of tests is way higher than the actual published number of tests. Okay, this is an issue today in the pharmaceutical research. So if you follow what's happening there, there is an organization called alltrials.net. And what they are pushing for is the publication of all randomized clinical trials. Basically what happens is that the pharmaceutical company will do these trials. If they don't work out, they won't release them to the public. When something does work out, that's a different story. It's released to the public. And you can see where I'm going here. You've got 20 trials, 19 of them fail, and the 20th actually works. Then how do we interpret that data? So pharmaceutical firms are very negative on this, and basically making excuses like, oh, we lost the records of these trials, which is ridiculous. So it's important to know the history of all the tests, and it provides a particular challenge. And what my research actually does is I propose a way to infer the total number of tests from what we actually discover. Like, I'm not going to go into that, but it is in one of my papers. Okay, so one of my papers is called ... and the cross-section of expected returns. And this is a play on the title of many papers. So there are over 100 papers with this exactly in the title. So it'll be factor and the cross-section of expected returns. Indeed, when I was editor of the Journal of Finance, actually, this is the motivation for my research. I was struck by the number of papers with the same title, effectively. So again, none of them controlled for multiple testing. So this is what it looks like in terms of the number of factors that have been proposed starting in 1964 with the famous capital asset pricing model all the way to today. And what I'm showing is the cumulative number of factors on the right and the actual production per year on the left. And you can see that this is an industry in itself, basically factor mining. And basically what I'm going to do is to propose a way to take all of the tests into account and redo the significance level for all of these tests and for tests going forward. Okay, so I'm going to use a multiple testing adjustment. In my paper, I actually go through 3 different methods. I'm going to pitch only one of them today, and it's the easiest to actually explain. So this is the idea of a Bonferroni test. So again, with a single test, we look for a 5% significance or 2 sigma type of test. So if we did the test and found that the factor had a p-value of 0.05, then we would declare that significant in a single test. So the Bonferroni adjustment is really easy to do. So if I tell you this is not a single test, that I actually tried 5 different things, then I take the p-value that I observed, 0.05, multiply by 5, and I get 0.25. which means essentially there's a 25% chance that the finding is by fluke, and I would declare it insignificant. So all you do is multiply the observed p-value by the number of tests, and you're done. And that's the Bonferroni test. So think of the XKCD jelly beans example. Suppose it was the case that for the green jelly beans test, when they looked at the difference, they got a p-value of 0.04. Okay. Now we know that 20 tests have been conducted. So multiply 0.04 by 20, you get 0.8. That is hardly significant. Okay, so you would declare, using this adjustment, you would declare that the green jelly bean and the acne were uncorrelated. Okay, so this is a very simple way to make an adjustment. And again, if a lot of tests are happening, you're going to need a very low p-value to clear the hurdle. So if you believe 5% is what you want, then if there are 10 tests, that p-value's got to be 0.5%. 0.5% times 10 is 5%. Okay, so essentially what this does is it makes the hurdle more stringent, which is exactly what we want to do in terms of multiple testing adjustments. Okay, so this is a graph from my paper, and other people have called it rewriting history. And basically what I do in this graph is that I look at the factor production, which I've already showed you, that's below in that thick green line, and then I extrapolate the factor production going forward. The line going across at 2 is basically the 2 sigma rule. Okay? That's the old rule that we used to use. Anything above 2 is significant. And what I've done with these other lines, the blue one is the Bonferroni adjustment. So here, what I'm doing through time is making adjustments for the number of tests that have actually occurred. Okay, so, and you can see that we jump above 2 immediately, and I've highlighted some factors, some popular factors that appear above or below this hurdle. And for example, the famous Fama-French 3-factor paper appears in 1992, and HML is value, SMB is size. Size was declared significant in 1992, but if you had used the correct statistics, it would have been declared insignificant in 1992. So there's some famous factors that are insignificant by this analysis, and some of them you recognize, like momentum, that are well above the line. Okay, so basically, instead of using this 2, I'm using a hurdle that is elevated. Okay, and when you do this, the conclusion of my paper is that I actually look at 316 factors that have been published. We conclude that over half of them are insignificant. Over half of them. So, also, by the way, some of them I proposed. Okay, so my colleagues, this is not just an attack on my colleagues, it's also an attack on my own research in the past. Okay, so that's important. Okay, so what I do, as I said, I allow for correlation, missing tests altogether, and we actually provide a technique. Let me go through a few additional ideas before I get into the questions. And one of the ideas here is Sharpe ratio adjustment. The Sharpe ratio is directly linked to this 2 sigma idea. Okay, so there's a relationship between the Sharpe ratio and significance. And what a lot of people do, they see a back test, and then they haircut the back test by 50%, saying, well, we think the data's been overfit, so let's do 50% haircut. Well, it turns out that that is a very crude adjustment, almost always incorrect. So basically, what we should do is the following. You observe a Sharpe ratio, transform that Sharpe ratio, it's very easy to do, into a p-value. And suppose we observe a Sharpe ratio is pretty high, the p-value is 0.01, which looks pretty good. Then what you can do is figure out the number of tests that were actually executed to get that strategy with the Sharpe ratio that's high. So suppose 10 things were tried. So we would adjust the p-value from 0.01 to 0.1 and then reverse engineer the Sharpe ratio. And when you do that, the Sharpe ratio is haircut. And it's haircut by the number of tests. So this is what it looks like, and for my 3 different methods. And notice that this is the 50% haircut, and this is my proposed way of haircutting. And basically, as you have a very high Sharpe ratio, the haircut is small, but when the Sharpe ratio decreases, when it gets smaller, the haircut gets severe, and it could be 100% haircut. So the Sharpe ratio goes to 0. Okay, so this is a very simple way to adjust Sharpe ratios and to get out of this mode of very crude statistics where we just cut them in half. That's not what you should do. That's a mistake. Okay, and I've got a program that's available on the internet for free. It takes the sample size into account, any autocorrelation and the strategy returns, the number of tests. You need to input that. So that's your judgment, the number of tests and the correlation, and it delivers a haircut Sharpe ratio. So again, it's available on my website, and the link is in my research paper. Okay, I've got just a few more things to say. One is, I get this question all the time, what about out of sample as an alternative to what you're doing? And out of sample is great, but as editor of the Journal of Finance, I get a paper, and it proposes a factor, it looks significant, and what do I say to the authors? I said, well, this looks interesting, resubmit your paper in 10 years to see if it actually works. I can't do that. And it's also in investment management, you're faced with a strategy, and it's not clear you want to wait because maybe it's true and somebody else is going to do the same thing. By the time you actually have got your out of sample, it's too late. And if you think that you can do the out of sample with the historical data, it's a challenge. It's a real challenge because you know the data. You know what's happened. You know there was a global financial crisis. So you need to be very careful. And indeed, there's other issues, like people split the data 50-50. So one part for the in sample, one part for the out of sample. But if you're using a small amount of data, like 50%, then you might miss some things because you don't have enough data. Well, then you can say, well, let's use 90% of the data, fit the model, then use 10% for the out of sample. Well, in the 90%, you're not going to miss anything, but you're not going to validate stuff with only 10% of the data. So again, the in-sample, out-of-sample is very complicated, and there's a number of hurdles to actually using it. Indeed, I've seen something that is just awful, where somebody will try a strategy in-sample, and then try it out-of-sample, it fails. Then they go back and tweak the strategy, in-sample, out-of-sample, it fails. Tweak the strategy, in-sample, out-of-sample, it finally works. That's not out-of-sample. That's just pure overfitting and data mining. Okay, I've got a recent paper called Lucky Factors, and let me give you the intuition. In the original graph I showed you, this one right here, that if we use the Bonferroni adjustment, we would say none of these strategies is true. So we do the right thing. None of them. But what if you group the best strategies here together and form a portfolio? That's a different story. So these are independent, there's no correlation in these strategies. You put them together, the best strategy here has got, it's almost 3 sigma from 0. And when you put it together with the next 4, it goes to 4.5. Okay, so this is a real issue. And what my paper does is it provides a way to actually select a group of true strategies. Okay, so instead of just looking at one at a time, it actually looks at the contribution of the strategies to a portfolio and allows for overfitting, all of this stuff. And it's a really simple method. And again, it's in a paper called Lucky Factors. And the idea of the paper, the title, is that some of these factors that are discovered are just by luck, a fluke. Okay, the last thing that I'll mention is this idea between type 1 and type 2 errors for a manager. And let me just pitch the idea very quickly. So you've got a portfolio of strategies. You're looking at a back test for a new strategy. And it looks pretty good. You add it to your portfolio, and it turns out that it was a false strategy. So it didn't deliver anything. Maybe it delivered negative return or zero return. That's a type 1 error. There's another type of error where you've got, again, you start portfolio strategies thinking of adding a new one, do your research, and is at the margin in terms of the back test, and you decide not to invest in that strategy. And it turns out ex post, if you had invested, that would have been profitable. That's a type 2 error. So the idea of my research is we can actually do a psychometric survey on this and give scenarios. What is the biggest mistake? So maybe I have two choices, A and B. A, you thought the strategy was going to deliver 10% per year. It delivered 0. And B, and with A, you actually made the investment. In B, you don't make the investment. You thought it was 0, and it would have delivered 10%. Which is the biggest mistake? Okay, and everybody would choose A, because that's what you actually invested in. But then you change the question. So we keep A as it is, but change B to, you thought it was going to be 0, but it delivers 25%. And at some point, people switch over. That point of switchover is exactly the trade-off between type 1 and type 2. It's something different that we haven't really thought about in finance. Like usually we think about a person's risk aversion in forming a portfolio. This is a different type of psychometric attribute that is important. It's your tolerance for either making a mistake or missing something that's true that could be the next big thing. So I think it's very interesting to try to measure that. Okay, so let me conclude. My research is about a mistake that people make in financial economics. It's a basic mistake of ignoring the fact that we're trying many different things. However, there's other mistakes that are made. There are many choices, and back test overfitting is only one of them. So there's so many choices that can be made in research. You decide to start your sample at a certain point in time. You decide to exclude certain events. I've seen research that excludes the global financial crisis. So, well, that's an outlier. No, you have to include it. Okay, so choices of data, choices of standardization, trimming and filtering the data, all these are choices. All these are choices that are in the same category as the overfitting and the backtesting that I've already described. Okay, it leads to incorrect inference. This is from the American Statistical Association, and they explicitly warn about multiple testing. So let me just read the last sentence here. So, or the last two. Selecting one significant result from a multiplicity of parallel tests poses a grave risk of an incorrect conclusion. Failure to disclose the full extent of tests and their results in such a case would be highly misleading. So this is part of their ethics. That's not how we operate in finance. It's routine not to show all the tests. And as a result, often what we have is misleading. I hope that I will establish guidelines for academic finance along these lines that were proposed by the American Statistical Association. I can do only so much in terms of my academic work. A lot of what's happening here is coming from the practitioner side. And there's rampant overfitting going on, and just the explosion of all these smart beta products is an example of a situation where essentially many people will be disappointed because they will be investing in something that they think is true, but it's basically a fluke. So let me conclude by saying that the 2 sigma rule is dead. Okay, we just can't use that. It's one test, and everybody knows that there are many tests going on. We just can't use that anymore. And I think that what's important is to develop protocols. I've got another paper that's not quite written yet, but it has to do with developing a protocol where you actually go and ask the investment manager a series of questions, and you can infer from that what their procedures are to minimize the overfitting. And I think that's really what we want. Again, the inference, my paper looks at academic studies that are published. The research that practitioners do is not published, for a good reason. Okay, but I do think that it's fair to conclude that the sort of insights that, that I uncover in the academic research applies to practitioner research also. So I do make the statement that over half of the product that's sold to investors is likely false. Okay, and that's pretty serious. So finally, I will say that the thought leader in this area is actually in medical science. So 10 years ago, there's a famous paper published in Medical Science that declared that half of the findings published in medical journals were false. My finding is identical. Half of the findings in finance are false. And you might think that, that's really serious in medicine, because it's a matter of life and death. And actually, I've got a different opinion. I'm willing to tolerate a high type 1 error rate in medicine because we don't want to miss the cure for cancer. In finance, I do not have a tolerance for a 50% error rate. So we need to do things differently. And I've advocated as one thing to move immediately from 2 sigma to 3. If it's below 3, forget it. I'm trying to get the balance back in place and to at least allow for some of these statistical biases to be corrected. And that is it. I'll take some questions now.
Thank you very much for your excellent presentation, Professor Harvey. So, has anybody of you a question?
Hello, Mr. Campbell. Thanks for that excellent presentation. I'd be very interested in 2 points. One is you mentioned the number of factors you tested, but for each factor there is like 1 million of types to implement them. Like, for example, you choose just the top 10%, the top 20 or whatsoever, or quarterly rebalancing, take relative or absolute rankings, and so on and so forth. How do you deal with this? Would that just increase the number of tests in a linear way, or do you take some correlations there? And the second one is transaction costs. Yes. That's what I find is the biggest problem of all backtests. And you just, or in fact it was a short time period, but that's the biggest problem. How do you cope with this?
Sure, okay, so on the first point, it's not linear because of the correlation. So you can have a set of factors that are fairly independent. And actually, it's really interesting. With the S&P Capital IQ factors, I looked at the average cross correlations of all those factors. And I thought it was going to be like 0.6. It was 0.2. So those factors are relatively uncorrelated. But you're correct that there are momentum factors, just one momentum factor, and there's 100 or 1,000 different ways that you can actually do that. But the key is you don't add 100 or 1,000 to the 400 because all of those are highly correlated. So what my paper does is it allows you to play with the correlation, to allow for that correlation, and the hurdle increase is not linear as a result. So definitely take that into account. Transactions costs, this is something that I've heard many times, and it's important for me also. We publish these articles in academic finance with no transactions costs. Okay, so as soon as you put them in, it reduces the significance level. So that graph of rewriting history, probably all those dots need to be brought down. So in contrast, the graph that I showed for Man AHL, that is with transactions costs. We don't look at any factor without taking into account a conservative estimate of transactions costs. That's just part of the process. We would never look at anything without transactions costs. So it is true, in terms of the practice of management, practitioners are much better at actually doing that, and it is essential. What I'm saying, do it after transactions costs, but you need to take the multiple testing into account. Okay? No microphone? There.
Okay, it's working. My question is, now that you're actually criticizing those backtests pretty much, what's your suggestion for asset managers to actually be creative and make up new strategies or develop new strategies? How could you do that then?
So basically what we need to do for asset managers, there's many things to do, and they're actually in my research papers. So it means that in order to actually put money on a strategy, there has to be a higher hurdle for declaring a true strategy. So the old hurdles need to be raised, and that's important. That's going to reduce the chance that that client money is put on something that disappoints the clients. Indeed, this is exactly aligned with what asset managers want to do. You don't want to go to a client, sell a strategy to that client, and then it underperforms. That's the last thing you want, because your reputation's damaged, you don't make any fees, all these things are important. So actually I've been very surprised by the reception in terms of asset managers, at least in the US where I've interacted with many of them. They've embraced this immediately. And basically they have changed their research protocols so that they no longer use a 2 sigma hurdle. So they're at 3 or even higher. And again, what this does is maximize the chance that the client is not going to be disappointed. That's good for them. There's also many other things that I've suggested. Again, I've got this paper in terms of that explores the research protocol at firms that are doing quantitative research. For example, I'll just give you a few examples. A standard question is, do you have a repository, a record of every single strategy tried? Yes or no? And if they say no, red flag. Second question, even if they do, you ask, what is your failure rate? And they should know immediately what the answer is. So things like that are really important. And really what we're trying to do, again, is to give clients, the actual investors, something that they can actually believe in. A higher chance that what is sold to them actually performs over the longer term according to their expectations.
A quick question relating, I'm not sure if you saw the earlier talk by Professor Schmidhuber about neural networks and artificial intelligence. So if we now move from human research into machines doing it, and this is endless tests, we're not talking about millions, this is going to be endless in terms of increasing computing power. What would be your opinion on that in terms of statistical significance, practical relevance, and application in finance?
Yes, so it is very important what's happening in machine learning. And there's many different ways to actually do machine learning. There's 6 popular ways. And it is just a classic situation where if you do not essentially correct for all of the things that you're looking for, then you overfit the data. Okay, so built into those techniques, and the ones I'm most familiar with are Bayesian types of techniques, and KNN types of techniques. Built into that is a way to minimize the chance of actually just overfitting the data. If you don't do that, then it just doesn't mean it. It's not going to be predictive. That said, I think that the best sort of applications of machine learning are probably not the applications that we would think in finance. Like if you give like stock returns to these algorithms, they're just so noisy that you're not going to find that much there. It's better to operate on machine learning to develop measures of sentiment and things like that, rather than just applying it to the actual returns. Nevertheless, this is all related to my research because it's so easy. It's so easy to do many different tests today. In the past, I had this exchange with Gene Fama, where he said, "I don't think your paper's right, because data mining's been going on forever." And basically what he was saying was, I was doing data mining Gene Fama in the 1970s, right? I'm doing it today. So why should we treat it differently? Because you notice the hurdle goes up through time. And basically, it was way different in the 1970s. Computing power was limited. The data was limited. And you had to go after the low-hanging fruit. The things you really had high priors were going to actually work. Whereas today, you can have almost no model. You just give it to the computer and let it actually figure out what's there. So I think that it is an issue, but the machine learning definitely takes into account multiple tests by construction for all techniques.
So there's one question from the audience. Would it help to repeat the tests with subsamples of the original test population and look for stability of the results?
Yes. So again, you need to have a metric in terms of how to evaluate a strategy. So I look at many different things, and I've mainly talked about, let's say, a Sharpe ratio. That's one metric. There's another metric where you might look at drawdown. That metric is somewhat problematic, but it only looks at a bit of the data. You might look at consistency within the sample. There's many different things that you could actually look at. You might look at recent performance versus historical performance. But this basic idea of looking at subsamples, one problem is that when you look at these smaller samples, it might not work just by chance because the sample is small and who knows what actually happens. This is kind of a method of cross-validation. It is important. There is another paper that I recommend by Lopez de Prado that develops, using a technique like this, a measure of backtest overfitting. And it's very elegant. So there's a number of people working in this area. This is important. I said in sample, out of sample is problematic, but you should do it anyways. And the way that we do it at Man AHL is that if an idea is approved, so before looking at the data, if the idea is approved, then we give the researcher a random partition of the data. So it's not like the first half and the second half. It's randomly selected, put together. The researcher does the work. We look at the output, have a seminar, and discuss whether to take it out of sample. And then the out of sample, the researcher is given the missing partitions. And that's the out of sample. And we would also look at the most recent performance. So there's different ways to do this. You need to have what I call a decision theoretic protocol for evaluating any investment. You need to sit down and figure out what's important, how much weight to actually put on each of the dimensions that you consider important. The key thing is repeatability. That's the most important thing. All of what I'm talking about is a method to maximize the chance of repeatability. Repeatability being that you see something within your sample and then that applies to the other sample. Okay? Again, I said at the beginning that my test was focused on backtesting. This also applies to real track records. The real track record can be just by chance. It will occur that a manager can outperform year after year after year purely by chance. It's easy to demonstrate that. Okay, so this type of critique also applies to real track record. Just because you've got a real track record, that is better than a back test. But again, it is problematic because it could be due to chance. And let me also say that this is a classic mistake investors make, that you invest in a manager, you look at the track record, you're satisfied with it, and then all of a sudden there's a couple of years of underperformance. You fire the manager. Okay, it's also possible that a good skilled manager suffers some bad luck. So the minimum you should do, if you are comfortable with the track record of that manager, take that track record and basically look at all of the possible permutations of that record. So what we do is kind of randomly reconstruct alternative histories with that track record. And you take this alternative history and figure out what the drawdown is, the maximum drawdown in 2 years. And then do another alternative history and figure out what the maximum drawdown is. And just keep on doing that. Do it 1,000 times. So 1,000 times you rerun the history with the actual track record that you were actually comfortable with. And then you can get the distribution of all of the maximum drawdowns. Then what you do is you look at what's happened and see where it is in the distribution of all possible histories. If it's never occurred in any of those histories, that manager should be fired. But what you're going to find is, oh, gee, this is actually pretty common. Like 30% of the time I see something like this. So so you need to understand the track record in a different way. And again, what we're controlling for here is chance. So it's unfortunate. Sometimes what happens is investors will drop that manager, and you know what happens. The next year manager does great. Okay, so you need to be careful on both sides. So it's not just that a manager looks good because of luck. A good manager can look bad because of bad luck. You need to control both sides.
So, letzte Frage.
Well, I'm not sure whether I can really share all of your concerns and critics, especially when it comes to, backtesting from quant managers and so on. Most quant managers that I'm aware of use factors that have been discovered 20, 30, 40 years ago. And it proved to be that these factors, once you apply them, continue to be significant. And if you have the 5 or 10 factors that have been all around in the industry, and what we find out, if you try to find the 11th or the 12th factor that add value to your forecast, it gets very, very difficult. So I think there is some value in backtests once you use things that have been around for many years, I think. So I think that's a very important point when you judge, backtests.
So I totally agree with you. So that graph I showed you, half of the factors would be declared true. So, and you see the ones that are very significant, those have worked fine in the out of sample. So I guess what I'm talking about, there's a lot of factors, 316. And these factors are being produced, new ones, every year. Those new ones, there's a high chance that they're not true. So I think I agree with you that if you've got something that's been proposed, and actually it's very interesting, the Fama paper, he proposed the value factor 2, right? His new paper has got 2 factors that kind of split the value into 2 components. And he argues that these 2 are better than the old value factor. And the statistics just don't support it, because the old value factor, it's got this large out-of-sample track record. And it's easy to find something using all of the data that does a little bit better. Is that little bit better going to be sustained out of sample? Probably not. Probably not. Yeah, it's an interesting paper nevertheless, and I don't mean to pick on him. He's actually my dissertation advisor, so I don't mean to pick on him at all. But I guess I am. But I think we agree on this, that if you've got something that has got this long track record, that has survived, there's another academic paper that's very interesting that has a different approach than mine, where it looks at what happens to performance of factors after they're published. And it's really interesting, because I think they have about 80 factors that they look at, and the degradation in performance from what was promised to what actually happens is about 30%. So I looked at that and said, well, that's actually not bad. Only 30% degradation. And then when you read the paper, you notice they start with 80, but the degradation is only for 60. So I said, well, what about the other 20? Or, yeah. So you said 80 you investigate, but this degradation of performance is only for 60. Well, I said, well, they couldn't even replicate the in-sample result for those 20. So those 20s were 0, and if you put it all together with the 80, it's over 50% degradation. Okay, so again, even if it works in sample, there's going to be degradation. In medical science, this is called the winner's curse. Let me explain it to you. You have a finding in medicine, you publish the paper. Now, all of a sudden people get excited, there's people trying to replicate your finding. There's 2 possibilities. Number 1, in the replication, the effect is smaller. And number 2, in replication, the effect goes away. It was a fluke, and the paper's got to be retracted. So the first one to publish is basically taking some of this luck into account. You publish basically the finding with the highest. So there will be degradation.
Professor Harvey, thank you very much. It was excellent. Thank you.
Okay, thank you.